Jacobson was able to advance slides and everything like that. So we are all good now, so we'll go ahead and get started. Again, thanks everyone for joining with us, and I really appreciate Mike coming on as well. Today we're going to be focusing on buying real estate in a down market. With the old saying of if there's blood in the streets, buy property. We're going to be going into a time right now where there's going to be a lot of opportunity, but making sure that we are positioned well to take advantage of some of the deals that are going to be coming our way is going to be very important. So again, really appreciate Mike being on with us today, and we're looking forward to having him cover some of this. So my name is Alex Perny. I've been with Advanta since 2012. I personally have had a hand in over $400 million worth of client transactions based in real estate, private equities, commercial real estate development, domestically and internationally. So this is something I'm really, really happy to be bringing to the table. Very passionate about doing these kind of investments through retirement plans, especially. A little bit about Advanta IRA. We have over 20 years of industry experience, getting our start back in 2002, sorry. We've been doing this for quite a long time, specifically focusing on doing things like real estate in retirement plans and getting all of those great tax benefits that IRAs offer us into IRAs for clients. So it's something that we have a lot of basis of knowledge in, and always look to bring new and good information and viewpoints to you to help make informed and profitable decisions for your retirement plans. We have over actually need to update that, $3.7 billion worth of client assets under administration. Any and everything that's held here, of course, is always FDIC insured, and we offer great personal client account management to anyone that has an account with us. So if you're looking to get started, or again, if you are a current client, again, I know you already you get to experience our great service, but if you are looking to make the jump into self-direction, we do offer amazing service, dedicated client account management for any and all accounts. So if you would like to learn more, again, please feel free to reach out to me directly on that front. Now, before we get it turned over to Mike, Advanta IRA and our employees do not provide any investment advice, nor do we endorse or promote any products. All information and materials are for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. With that said, I'm going to turn it over to Mike real quick before I give it over to Mike to get through this great content. Please keep in mind that if you do have any questions, make sure that you ask them. Your audio on your end has been muted, but you can type those questions into the chat box, and they will be available, and I will get those up and over to Mike throughout the presentation. I'm also going to be attaching the slides as a handout to this presentation. So if you would like those, they are attached right there for you to snag. Oh, whoops. Sorry about that. Okay. Yeah, just want to make sure it's the right file. So again, they are attached right there. And Mike, I will go ahead and turn it over to you. Thanks again for joining with us. The most valuable resource we all have is our time. So thanks for taking some time out to talk about this great topic today.
All right, thank you, Alex. Just a little bit about my background. I obtained a real estate license in 1982 and worked in real estate for a little while going to school and worked for my dad, and then went on to school and ended up going into engineering, retired as from aerospace engineering, and I've been investing in real estate since about 2006, so it took me a little while to get started, but anyway, then I've been investing funds through my IRA at Advanta, and that has certainly been one of my favored custodians to work with. So just a plug for you and Advanta there, Alex. I appreciate you having me on today, and hope I can share some helpful information with everyone. And we've seen a number of cycles going up and down through the market, and so I'll share some of the things I've seen, and so that's a little bit about my background, and we'll talk about why downturns create opportunity. And we should not fear them, but learn how to take advantage of those and try to avoid some of the costly mistakes, especially some of the ones I have made, and want to see how to identify the next recovery phase. So once you are in a downturn, how do you know? It's hard to know how much longer you'll be there, but you want to be able to recognize the signs and jump in before it's too late. So why do the down markets create opportunity? There's a lot of investors that fear down markets. You see it may be more obvious in the stock market, where something happens in the news, people get scared and they jump out of the market. You see a lot of volatility in the stock market. We don't see quite the volatility in real estate, but we do see the fears. And when there's blood in the streets, that's really the best time to buy. We saw that back in 2008 and 9. There were some golden opportunities that some people were able to take advantage of. Some of you have been in the market since before that, others since then. And the real wealth is built during recessions, because that provides the greatest spread between where we buy in and where the market peaks. And even when we have a peak, it does not mean the prices are going to go down. That is kind of a misconception for some of the cycles. So sometimes it may kind of plateau for a while. It may stay stable, and you may have some inflation and not have real price increases. But a lot of times the housing prices have stayed stable. Sometimes we see a little more variation in the commercial side. But then we're going to look at some of the fundamentals. Cash flow and sustainability are some of the real keys to be able to surviving through a down market, making sure that regardless of when you buy, you want to be able to hold the property for the long term. You don't want to get in trouble when things go south. So some lessons from the 1980s. Some of you may remember when the prime interest rate hit 19 and 20%. And some others may wonder, how in the world did people even buy houses then? But they did. And Congress, well, let me back up a little further. Ronald Reagan, when he was in California, he found he could make 2 movies a year and make some pretty good money. But if he made a third movie between the state taxes and federal taxes, he would have to give 90% of his earnings from that movie to the government. And he did not like that and decided that was something he wanted to change. So after he was elected president, he moved forward trying to get some of these changes, and Congress passed the Tax Reform Act of 1986. Within that act, they also restricted the deductions that certain investors could make. So people like doctors, lawyers, engineers were limited on their passive losses. So now properties that had been bought as tax shelters would be a problem. These were largely funded by the savings and loan institutions, investors buying duplexes, apartments, larger buildings that would not cash flow, but because of the depreciation losses they could take, all of a sudden they could take a negative cash flow, turn that into positive cash flow after taxes. That was because of their high income tax rates. So this Tax Reform Act that was supposed to fix one problem, it triggered the S&L crisis, and a lot of savings and loan institutions went under. A lot of properties ended up in the hands of the resolution trust companies. So this was unintended consequences, but the lesson is that policy shifts can reshape the markets. They can totally change the way things work. So now let's fast forward a little bit later. Now we're into the 2006 bubble. The low interest rates and actually the easy lending practices, easy credit, led to the bubble that we saw in 2006. Then the Fed increased the interest rates and popped the bubble. That caused the greatest decline that we have seen since the Great Depression. Prices dropped 30 to 50% in a lot of markets. And then whereas many cycles should only be about 7-10 years, you can see that from the peak in 2006 to, we had a drop. The bottom was around 2011, but even in 2020, prices were still going up. That is 14 years, and we still had not reached a peak. So, what are some of the lessons? The government can, slight changes or quick changes in policy can cause an adverse effect, and that can trigger a recession at any time. Are we in a recession now? We have some conflicting indicators. We can look at the GDP estimate in the bottom chart, and we can see that that dropped during COVID, and then after that, GDP has been increasing fairly steadily, for some time. We don't see a drop in the GDP at this time. The monthly inflation rate, we can see around 2020 where the inflation rate dropped at around the time of COVID. Then inflation started picking up again right at the beginning or middle of 2020, and then around 2022 where you see the drop. That is when the Federal Reserve started to increase the interest rates about 3/4 of a point at a time, and they raised the rates about 3% over the course of a year, and that has had an adverse effect on the housing market. The unemployment rate in the bottom right chart, looking at that from 2015 to 2025, we see a huge spike up at the beginning of COVID. Then employment rates started coming back down again, and since about 2022, it's been under 4%. It's been fairly steady, running around 4%. Even the most recent estimates there have it under 4%. So that indicates a fairly strong job market. So we're getting some we don't have the interest rates on here, but we know that interest rates have been one of the triggers to slow down the economy. But we also know real estate lags the overall economy. So when a trigger may happen, it may take a while for that to be seen in the real estate. And then the local markets can differ widely. We see what goes on in New York, it may be vastly different from what goes on in Texas or Florida. You have different building patterns, and so that's one of the things we like to look at. We like to go to different markets to diversify, and we may talk a little bit more later about how we do that. So understanding the market cycles, we've got several phases. We start off with an expansion and end up in a hypersupply. And then after the hypersupply, we'll go into the recession. So the expansion is where we continue to go up. I don't know if you can see the cursor, but it's going up to the peak. And then the hypersupply is after reaching a peak. We continue to build, but we have overbuilt, and now you end up seeing apartments don't get absorbed as fast, that type of thing. Then during the recession, then we'll go into the recession, and after it bottoms out, then we start the recovery. And the recovery period is from the bottom up until you reach the last peak. So when you look here, it took us from 2006 until around 2016 or 17 just to recover. Now, well, we had the downturn, but if the bottom was in 2011, it took 5 years just to get to the previous peak. And so we have continued to expand beyond that. So whereas you normally have a 7 to 10 year cycle, this is a really long cycle. We're seeing on the order of something over 14 years. So now we're looking at probably something like 16 or 20 years, peak to peak. But each downturn creates opportunity. And if you looked at the two downturns that we pointed out earlier, the one following the S&L crisis in 1986, and then the one in 2006, 2007, each downturn creates opportunity. It may be caused by a different trigger, but there will be different opportunities that arise. In the downturn following the S&L crisis, there we saw a lot of commercial properties were available at cheaper prices. I remember duplexes were being bought for 30 cents on the dollar, just because the previous owners, the cash flow couldn't make it. In the more recent crash, we saw opportunities in the single family market where houses, we were buying houses, 25 to 30,000. There were many of them in that price range, and it was just phenomenal. Like I said, the best buying opportunity since the Great Depression. But we don't expect every recession to create that type of opportunity. So there are certain fundamentals that we have to pay attention to. So what are some of the triggers and warning signs? We mentioned interest rates earlier. When the Federal Reserve started raising interest rates 3/4 of a point back in 2022, that was a significant jump. And that was one thing, whereas before we had seen cap rates compressed on commercial properties. When we saw the interest rates going up, we knew that there was going to be trouble ahead, because you have to have a spread between the price you're paying for money and your cash flow. You need to have a positive cash flow, and if you're going to be paying more for your funding, then there's a problem. So the cap rates would have to go back up. When the cap rates go up, the prices go down. So the Federal Reserve continued to raise prices and the interest rates for that 3%, and that just really compressed what investors could pay. There were some investors, projects that had been funded with bridge funding, and they thought they would be in and out in about 18 months, and all of a sudden interest rates went up. They could no longer refinance the property at the new interest rates. In the single family market, we have seen the same thing. People are locked into a house at 3%. They don't want to move. So what's going to happen? You're not going to be able to, you're going to have a shortage of housing where other people can move into, but you're also going to restrict the number of people who can be first-time home buyers. So that really has slowed down the housing market. Then you can also have overbuilding or oversupply. We've seen here in Daytona Beach a lot of apartments going in, and I wonder, where are the people coming from that are going to fill these apartments? It just seems to be a lot of apartments right now. If you look at the numbers, well, we start looking at, people are finding housing easier, but they also, we've seen some of the apartments dropping rent. So you may have a new apartment, a new 1 or 2 bedroom apartment, and they've dropped the rent $100 year over year. That's indicating that we have an oversupply here. Policy or tax changes. When you have a change in the tax laws, tax rates, policy, that can have an abrupt change. We have seen on the positive side, when you have, for example, a first-time home buyer tax credit, that can make it easier for somebody to buy a house. That's great for providing housing. We've also seen when that tax credit goes away, now people are able to spend a little bit less on the house. Well, that's a change. What about affordable housing or Section 8? If the federal government is going to continue to fund programs, then that money is flowing in. If there's an abrupt change, a drop in funds, then all of a sudden there are going to be fewer people who are willing to provide that type of housing, and you can see a change in that market. How is it going to change? You've got fewer investors that are going to be interested. So you might think, you just have to think about where it is you want to be and look at the demand, but know that there will be changes. We also see geographic shifts. During COVID, we saw a migration from some states, like from New York to Florida. We've seen California to other states further east, like Texas. We've also seen can be other triggers. We've seen people disappearing from Texas. We've got population drop in Houston, and the occupancy in apartments there has dropped. So so all of these changes will change the demand you have for your properties, and you just have to watch out for them and be aware that something can happen. So in the case of Texas, fortunately, we have good property management, and they will react to the changing conditions to continue to bring people in to fill the apartments. So what are some of the traps to avoid? We've got negative cash flow can drain the reserves, and that is one of the biggest. We saw that during COVID, when you get people moving out, or they decide to stop paying the rent and we couldn't pay, or you couldn't get evictions through the courts. Well, that causes a negative cash flow, and you can end up having to start digging into your reserves. If you're having to pay more for your mortgage, that can put a strain on your cash flow. Higher insurance cost in Florida, that's another thing we've been dealing with. So you want to look at these things before getting into the property, so you know what are going to be your expenses and have a really good handle on what your cash flow is going to be. The changing laws can hurt the returns. We've talked about how some of those can affect. How about a change in the flood insurance or the zone, the flood zones? So if you all of a sudden the flood zone comes in, is your property is rezoned to be in a floodplain, that can change how much you're paying for insurance. And then when watching the market, timing the bottom is nearly impossible. I mean, we can see signs of what's going on, but to really try to time the bottom and say, hey, we think it's here in July. Well, trying to get a property under contract and close in July because that's when you think the bottom is, that's kind of difficult. But if you look at your cash flow and your other expenses and stick to the fundamentals, then that will protect you through any downturns. So what are some of the signs? Trouble ahead, rising vacancies. You can see those looking at some of the commercial real estate reports. You find out what occupancy is, what the vacancy is, and then find out when rent is dropping. We've seen year-over-year rent growth. That growth has been decreasing. Sometimes we've seen rents dropping. Especially when the rent drops, we want to exercise caution. In the single-family market, longer days on market. When we would flip properties, we like to look at what is selling within 30 days. You also look at what is the median time for sales. It used to be the median time for selling was somewhere around 55 to 60 days. And that was a normal market. Excuse me. So when the days on market got longer, like 3 or 4 months, that indicates a lot of trouble. But we also saw recently, just a couple of years ago, sometimes the property might only be on the market for 10, 15 days, less than 2 weeks. You saw multiple offer situations. So that was really a climbing market, and people kind of got used to it a little bit. So when the days start stretching out to 30 days on market, it's really moving back to normal. And we shouldn't worry too much about just the fact that days on market are increasing, but when they get past the normal range. So how about, how do you recognize the bottom recovery? And that's actually a good sign when you can start to see the recovery. The prices stabilize. During the Great Recession, we saw hedge funds come in to buy. And I was thinking to myself, this is really a good thing because they have now set the bottom. They've set a floor at what prices and houses will go for, because the housing did need to stabilize. And so maybe it was 25 or 30,000 on some houses, and it went up, but it was but having their floor. You don't know where that floor is going to come in from. And frequently you see investors start to buy more when the prices get to a certain point. Then the rents will start rising again. So we've seen some rents dropping right now. When we see the new rents start going up a little bit, leveling off and going up, that's a good thing. So then we know we're back, we're entering the recovery phase and climbing up again. And investor activity returns. Start looking to see how many of the sales go to investors. How many of the sales are cash sales? Those are the kind of activities that indicate we are coming out. And you don't want to be left behind and wait until, you don't want to wait until prices get back up to where they were, because then you will have missed out any significant part of the growth. So one of the things I feel really strong about, you hear cash is king, but that's not quite right. That may get you into some properties, but cash flow is what enables you to hang on to a property and keep it growing throughout any market. If you have a positive cash flow, you can hang on pretty much forever. And that protects you from the downturns. But you have to maintain that cash flow. Watch your expenses, because when the rents drop, you have to keep your expenses in check. Watching your rate of return. You have to watch your key performance indicators. Just keep an eye closely. Try to make sure. Sometimes shop around for your insurance. What is the best insurance or cheapest insurance you can get, so you can keep those expenses down and have your property management company keep the occupancy up and the rents up to where the market will allow. The market cycles are local. So what's going on in Texas is not necessarily what's going on in North Carolina, Minnesota, South Dakota, California, and even within a given state, it can vary city by city. So personally, we kind of like the tertiary markets just because they're a little bit smaller and less competitive, but but be aware that you can have a boom in one area and declining in another. Another thing we saw was up in Minneapolis and St. Paul. I think it was St. Paul that had increasing rent controls, and there were all of a sudden developers said, well, if you're going to have the rent controls here, we are leaving, and they went over to Minneapolis to a more friendly building environment, and less regulation, and where it was more profitable. So there you have two cities next to each other that could have differing market cycles just because of the influence of the local government. And then look for the path of progress. What areas are growing? that's, you can look at the U-Haul patterns. Where are U-Haul trucks migrating to? That may tell you generally, that will tell you what cities are people moving to, and that gives you a path of progress. Is there something restricting the growth? Like if a city is landlocked or locked, like if you're by the ocean, where there's pretty much away from the ocean is the only way you can grow. It might be north or south. If you have a river, sometimes that may be a natural barrier, and other places are just growing in all directions. But kind of look for where is that path of progress. The biggest mistake we ever made was in 2006. In January, we bought a condo at Myrtle Beach. It had a oceanfront building, and the prices were going up. Wife and I wanted a beach condo. We said, if we don't buy it now, we'll never be able to afford it. Well, that was a huge mistake. It looked good on paper when we compared it to all the other condos along the beach. We looked, hey, for what we're getting into it, we know it's going to be a negative cash flow, but we thought, we could afford it and decided to get in. But that negative cash flow was a big problem because it was costing us initially around $1,100 a month, and over time, as you find out, you have to put other money into repairs. Somebody blows up a microwave, you've got to upgrade your furniture or something every year to maintain the standards within the building. So we were losing about $1,500 a month, and we were not able to refi because it was in an LLC. We continued to lose equity. From the time we bought it in January, we paid about $254.9, and then prices started going down that summer. They bottomed out around $70,000. It never did fully recover. We sold it in 2018 for $127,000 or $128,000. Had to take $70,000 to closing to get out of the property, and it still has not recovered to what we paid for it. And so, that's where the lesson about cash flow comes from, because it was just eating at us all the time and kept us away from other opportunities. So don't let the emotion drive your investment decisions. It's just, you don't want to become a motivated buyer. We look for motivated sellers, but don't be the motivated buyer.
And hey, I got a quick question for you there, Mike. So we got a couple of questions that filtered in. One was on where can you find the U-Haul patterns?
I believe that U-Haul actually makes those available.
All right. And what resource do you suggest following for tracking real estate KPIs?
There are, let's see, I think Yardi Matrix has some. There's CRE Connect is I think that's commercial real estate. They frequently put out articles, I think, about every day. Let me see, I'm trying to think who else. Marcus and Millichat puts out information. So some of the larger brokers will do that. And then some of the other KPIs, those are the ones I'm monitoring what commercial real estate is doing right now. There is, what was the Case-Shiller Index is another one to indicate the housing affordability. Okay, that should answer the KPIs. Are there any others?
No, that's the two questions that we had just pop up. So go ahead and keep on rolling.
Okay. So that was that covers the biggest mistake with a beach condo. So some of the strategies for buying in a down market, we like to buy for income and creating value, but we don't want to speculate. That's why I have a hard time accepting when people buy just for appreciation. You might be in a path of progress, or might be in a hyperinflation area, but if the cash flow is not there, I'm really concerned about being able to hold on to that property. How do you pay for that property over time? You know, the property needs to pay for itself on its own. We want to use conservative financing assumptions. That means if the current cap rate on that type of property is 6%, then when we plan to sell it in 5 years, I'm not going to count on cap rates continuing to go down to 5.5 or anything lower. I'm going to assume that the cap rate is at least as high as it is right now. I might even bump it up a little bit and say, hey, if the market turns south and the cap rates go up, this is where we're going to be. It's going to squeeze our returns. Are we going to be, if you're doing a renovation on a property and have to get bridge funding, what are the interest rates going to be 18 months out? That, you know, sometimes you have to, that can be a challenge. You know, we don't know what's going to happen between now and then. So you want to try to get the long-term financing locked in as early as you can. And some apartments we did before, we were locked in for 12 years with a Fannie Mae loan. And that should be enough time to ride out any recession, but we ran into other issues and decided to sell early, which, you know, but the idea being you want to get financing that will carry you through a recession if you think that it may be in the next few years. We also diversify by the market and asset type. So by the market, I've mentioned we like to invest. We're invested in Florida, Texas, South Dakota, and Georgia. Now we like to go into different markets. If we had all of our houses in Florida, in the Daytona area, we could have a lot of damage from a hurricane, and that could end up having a huge impact. But by diversifying into multiple syndications across different states, that helps to reduce our exposure to various risks, external risks, but also gets us into different markets, different market cycles. And also the asset types. Sometimes we'll invest into mobile home communities. So that's, you know, just another way to diversify. When possible, you might be able to structure with seller financing. A word of caution, just because the sellers offer financing does not mean that is your best financing. It might get you in with less money down, it might not, but you want to be careful with that so that you get good terms that work with you. You might be able to pay more for a property, give seller their full price offer, but you need to stretch it out over 10, 15 years in order to make the cash flow work. Remember, it comes down to the cash flow and being able to structure the terms for the long haul. And then this isn't actually buying, but if you have funds in your Advanta IRA or account, then you might consider lending with to someone and taking, instead of just interest, a fixed rate, you might take shared appreciation. So I like this because it helps you capture some of the upside without having to own the property. And this is a great strategy. I like it because it's hands off and you still capture the upside. So Some other practical strategies when buying for the cash flow, we look at the rent to price ratio. People say the 1% rule doesn't work right now. That's right. It is very tough for most of our properties. When we're looking, and if we don't find something that fits our criteria, we're not going to buy it. But I have someone else who I'm lending to right now. He's actually getting 2% on the rent to price because he is buying in an area where the houses are just so cheap, but the rent is high enough that it becomes a no-brainer. So it's like, yes, I feel safe doing that, but just in this particular case, I don't want to be the buyer, but I do want to keep my money working. So there I'm lending at a decent rate. The BRRRR strategy: buy, renovate, rehab, refi, and repeat. That strategy became very common. I like it. I've used it a number of times. Using money with people's Roth IRAs to buy a property, fix it up. But right now it is tough to find the properties because of the higher interest rates that you refinance at. So if I refinance at 7%, then I'm not going to be able to get back all the money I have into the property. So I have to look and see, hey, if I'm going to leave $25,000 or $50,000 in the deal, is my cash flow going to be sufficient? Is it going to be acceptable? But that is a strategy that can work in this market. We just have to accept the fact we don't get the same kind of leverage we could 5 years ago. Syndications. This is one of my favorite right now. This is what my business partner and I have been doing. We like to find proven operators who are buying properties at a discount. Sometimes it may be a short sale. They may be buying out of a foreclosure, but they might be negotiating with a seller. Sometimes they're taking over from a previous operator, but they are proven operators who have done a significant number of commercial deals, and many of them have been investing since before 2006. This is one of the things that I like to look for, we like to look for, because they have a history of investing and have survived the down markets in the past. And this also helps us just to diversify across different markets throughout different cities and states. Then we have the creative deals, the seller financing, subject to. When negotiating with a seller, if you can get seller financing long-term, that can be great. You buy subject to the existing mortgage. Those are also opportunities. The golden rule, I meant to skip over this one. And where are we now in the market cycle? So let's take a look at some of the local inventory, the rent trends, the cap rates, and the job growth. And you want to look at those. Somebody was asking about KPIs earlier. Those are the kind of things you want to try to find out in your local areas, because each region is going to cycle independently. So we want to act locally, but also look at the national trends. And that's where you can also get the KPIs or find out the current status based on like Connect Real Estate or CRE, or we said Marcus Millichap earlier. So find out where, what the overall is, but also the local. And here's another sheet you can use to kind of look and see where are we right now. And the arrows are direction compared to the previous portion of the cycle. So in the down cycle, the new supply is decreasing, the demand is going down, vacancy is going up, the rent growth is going down, cap rates are increasing. And remember, the cap rates may be slowly increasing. You don't always see them right away. You don't necessarily see them by the sellers, but they need to be reflected in your offers, because you need to make the offers based on your cash flow and what you can do, not what the seller is asking. And I can't tell you how many times we've seen this. I would rather not buy a property than get into a bad deal. And then the investor interest is decreasing. Then when we start going up, which is what we're going to be looking for, is the new supply. Well, that's going to be kind of constant, because the new supply is just going to kind of bottom out and just become constant. Demand's going to start to increase again. Your vacancies are going to start going down again. Rent growth will start increasing. Cap rates may start going down. So this is one that you talk to your local broker in the area you're interested in and find out from them, how are the cap rates changing. And then the investor interest starts to pick up as soon as people really think that the market is headed back up again. Construction cycle, we have the new supply starting to increase now. The demand goes up. It'll be stronger the demand than it just when the cycle is increasing. Vacancies are going to start to close up. Rent growth is increasing. Cap rates down. Investor interest keeps increasing. And then as the market gets saturated, the new supply keeps going up. The demand starts to drop. Vacancy will go up again. Rent growth starts decreasing. Cap rates increasing, and investor interest will start to peter off again. So that's kind of how you can match where, I mean, take your external signs and look at some of your KPIs and say, with these indicators, this is where we are now. You can kind of find it on here. So just wrap up key takeaways. The real estate cycles repeat. The cash flow protects your investments. Cash flow is king. I can't say it enough. And then buy based on the value, not the hype. Don't be scared of what everyone is saying, but go look for the numbers. Verify it yourself. And when I say buy value, we like to buy value add properties, because that's where you can go in and make a change and force the increase in value and create value there. So, do we have any questions?
Yeah, absolutely. Let's forward it over so the contact information's filed up there. So question came in, how do you manage all of your properties in so many different geographical areas?
Many of these are passive investments. In fact, in the other states, they are passive, and we have shifted from wanting to be syndicators ourselves to identifying other syndicators who are managing the properties, and they find good asset managers, or they are good asset managers and find good property managers there. So that helps us to diversify. If we had single family rental somewhere, I would definitely have a property manager, a good property manager there. And I do have some property in Georgia, and there we use a property manager. Part of the reason for that is because the property is in my Advanta IRA, and I have to keep my hands off of it. So I have a property manager there.
Yeah, absolutely. Now, when it comes to looking at some of the metrics, was kind of a question that I posed when we were going through all of this. When it comes to looking at different activities, right? You know, you have to look at new inventory coming on the market. What is the building market doing versus what is the days on market of a particular market segment that you're looking at, as well as the other things. One thing that kind of gets a lot of press is kind of the stress on the builders market. And I don't know if it's necessarily accurate to say that should be weighted more or less than other things, but do you feel that the activity of the builders is a really good litmus to look at, or do you kind of just use that as a equally weighted portion of the analysis of where the market's at to make your buying decisions?
That is mixed, because it is a good litmus, because when the interest rates go up, the cost for builders goes up. The builders see that people are not buying single family homes as much, and they back off. And the single family builders, I think, can react more quickly than the commercial builders. It takes longer to get permitting and site prep for an apartment complex and to build that out than it does for a builder doing single family houses. You can have a developer that comes in, he can have a whole neighborhood ready, for builders to come in, so it's, the developer needs to kind of have a longer horizon, but the builders can actually be more responsive at that. And so I do like to see building, I mean, it depends on which market you're looking at also. If you're looking at single family, yes, building permits are a good indicator. For a commercial market, it's a longer lead. And that's why we saw so many projects that were just put on hold when the interest rates were going up. And then when they started settling out, people said, okay, we've waited long enough. Interest rates are not going down. We're stuck here for the long haul. This is a new reality. Then we started seeing some of the commercial markets picking up with the building again.
Yeah, and I think also, especially just maybe a little bit of a hyper-focused issue is tariff issues, right? It's builders maybe not wanting to eat the cost of increased, cost of just building materials on some things and waiting for some stuff. So I think at least for the market currently, there's a few more kind of external factors that need to be taken in to properly weight that as a decision, a data point, if you will, at least just kind of from what I'm seeing as well. So
right, yeah, because like you say, the tariffs, that's like a whipsaw. People react to it, and but then things stabilize out.
Yeah, exactly. Well, again, Mike, I really do appreciate you being on with us today. It's always great to hear from people that are boots on the ground doing these investments. Not just doing them professionally, but personally as well. It's always great for people to get to peek behind the curtain and see how real people can actually go out and do these investments. Now, some people aren't necessarily looking at this visually, so it's just audio. So if you can let people know how to get in touch with you if they want to connect as well, that'd be fantastic.
Sure. And first, I want to thank you, Alex, for having me on today. I've enjoyed this, and I hope that we have provided some value to our listeners and people viewing. Yes, you can connect with us. Email is mikej@attuneinvestments.com. That's attune, ATTUNE, investments.com. And our website is www.attuneinvestments.com.
Alrighty, again, really appreciate you being on with us today, Mike. Again, everyone, thank you very much for joining. That's the end of our webinar. If you do have any questions, I encourage you to reach out to Mike. This will be posted on our YouTube coming up shortly, and these slides are attached as a handout. We do these webinars every Tuesday and Thursday, depending on if it's too close to a holiday, at 12 o'clock Eastern time. We also have a podcast every Wednesday. And don't forget, if you want to connect with other investors, we have our Pitch, Promote, and Prosper open networking pitch call that's held every last Friday of the month. And yes, it will be on Halloween next week. So looking forward to seeing everyone there. Again, this has been another webinar with Advanta IRA. Thanks, Mike, for being on with us today, and have a great rest of your day, everyone.